Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is December 2nd, 2024, and it is a weekly markets update. Let's have a look at the news of week 48 and see what are the next trends. Today, I would like to start with a small celebration, because this is the 50th video in my channel after 6 months online. I would like to thank you all, my dear subscribers and watchers. I wouldn't go that far without your full support. And I would like to ask again those who still haven't subscribed, please do so, as it helps to spread the voice of fertilizers industry further. And I will be here for you for the next 50, 500, 5,000 and hopefully many more videos. End of November and December is usually quiet in the international markets, because most of them are in between season modes and activity is being subdued before Christmas holidays. So, urea demand is unsurprisingly subdued, which drives prices further down. Discussion around potential next Indian purchasing tender evolved amid healthy domestic sales in November. So maybe we are going to see one more tender finalizing this year, somewhat around end of December. If it happens, it will be the 7th tender in a year. If it happens, it will help support global prices even before the key purchasing season in Europe and other markets. In Europe, all countries were quiet. Only Romania showed some signs of purchasing activity. Several large cargoes are being discussed or purchased during past week at around $365 to $70 CFR duty paid. There are rumors of multiple European nitrogen producers cutting down production, including Fertiberia, LAT, Borealis, at least until demand will pick up in early 2025. SOCAR finalized its sales tender for 30,000 tons, targeting around $320 to $30 FOB, which is only achievable for the premium Ukrainian market. Activity in Egypt was limited, marked by MOPCO sales of a small lot at $360 FOB. Egyptian producers will most likely wait until demand pick up, being quite comfortable now with the stocks for December. Nigerian producers Dangote sold 3 lots of 30,000 tons each at the level plus-minus $310 FOB. Spot activity from the Middle East was muted last week, and prices dropped from $5 to $10 more to the level of $335 to $40 FOB. There is very limited demand from the traditional markets in upcoming months at least. Currently, only nominations for the Indian tender are ongoing, as well as for the Ethiopian tender. Iranian FOB prices slipped further to the level of $285 to $95 amid piling stocks. A significant amount of product is available for loading, but demand is not there, even at these levels. Turkey is purchasing, but very, very slowly now. 2 Iranian cargoes are expected to arrive in upcoming weeks at estimated level of $330 CFR duty unpaid. Other than that, Iranian producers are struggling to find outlets for their products. 2 sales tenders for total amount of 90,000 tons for first half December loading will close this week, but a couple of previous tenders were scrapped due to no interest, which might happen again. In Brazil, purchasing comes to its end, so subdued demand and pressure from significant floating volumes weighs on the price level. It slipped to $325 to $30 CFR. Similar tendency is evident for other South American markets. USA had a short week due to Thanksgiving, and market showed no demand. Barges were traded around the level of $307 to $15 FOB NOLA, similar to last week. The demand is also expected to pick up in January, but it is a question mark how much USA is going to import. Paper values moved differently for different benchmarks. Egypt FOB marginally corrected upwards to the average of $360 FOB for December, January and February. Expectations of sluggish demand in December pushed NOLA FOB down by $6. However, expectation for next season purchases starting January supported further level that reached average $320. After a dramatic drop a week ago, Arab Gulf FOB rebounded for all 3 months ahead amid new Indian tender possibility in the air, as well as expectation for better demand across key consuming regions in January. Thus, average FOB level for December reached $342, for January and February $340 FOB. Brazil CFR level for January dipped to the average of $340 due to pressure from floating volumes. Ammonium sulfate standard product price in China remained stable last week at the level of $130 to $35 FOB. At the same time, European supply remains tight, with most of the producers sold out for December, and natural gas price increase pushed forward some demand for Chinese product. Rumors circulated about at least 2 Panamax vessels heading to Europe in the upcoming month. Turkish buyers also seem to be quite active, with another 10,000 tons lot of Chinese standard product sold to the market last week, adding to at least 6 other vessels heading to Turkish ports in upcoming 2 months. Granular FOB price in China also remains stable at $140 to $50 level. However, Brazil, moving quickly to the end of the purchasing window, is expected to pressure prices in upcoming weeks. Also in Brazil, there is a lot of inventory that weighs on the prices. Thus, fresh arriving volumes are being liquidated at the level as low as $160 CFR. AMSUL prices in the US continued to increase due to tight domestic supply. That stimulated traders to purchase products outside of the US. There are rumors that domestic producers have certain production shortages, most likely due to increasing raw materials prices of both ammonia and sulfuric acid. Indonesian Pupuk Holdings closed its tender for supply in 2025 on Friday. According to Argus information, 14 offers were received. More details will be available shortly. In the meantime, Pupuk Indonesia issued one more tender for purchase of 99,000 tons during 2025. We will know the results this week. Nitrates prices in Europe continue firming for another consecutive week amid increasing gas price. LAT and OCI have lifted the price to 310 euros CIF. However, no sales are made on this level so far. The market is taking it as a clear sign that prices will not come down before the start of the season. Taking into consideration the high gas price, the possible restrictions on Russian product, and the low coverage of the farmers and wholesalers, this has created demand and prices are moving up slowly, but steadily. In the UK, demand is almost non-existent due to weather concerns. UAN market continues to be inactive both in Europe and in the US. In ammonia, the main news of the week was new contract price in Tampa for shipments in December. Many market sources expected it to increase versus November, and it did by $10 to $570 CFR, which is the highest point in 2024. This increase is a result of firming prices in Europe, where last week the price surged to $625 CFR. In Asia, the situation didn't change much from a week ago. The demand remains limited, with prices mostly stable. In phosphates, activity remains rather limited overall. Indian FLDAP tender confirmed to be concluded with Russian product. Prices CFR last week were slightly lower compared to previous one, at $633-34 CFR. Bangladesh received offers for its tender announced earlier for DAP and TSP. DAP lowest offer is at $685 CFR, up by $7 compared to the previous tender. Similar for TSP, lowest offer is $567 CFR, up by $6. There are rumors in the market that some phosphate producers are reducing production levels because of high feedstock price, particularly sulfur, as well as ammonia. At the moment, sulfur is at highest level in 2 years. This keeps phosphate prices from downward correction, which would be logical if compared those with nitrogen prices. Chinese producers sold a lot of 10 to 15,000 tons of DAP at $615 FOB to Central America, with shipment in January most likely. Demand in the Brazilian market is finished No new deals registered. Thus, MAP price is stable at $635 CFR. That holds for almost a month now. Activity in NOLA was also very slow, also due to holiday week. December DAP was traded at $565 to $70 FOB, MAP at around $605 to $12, however, no actual sales. Moving to the fundamentals. European natural gas futures surged to almost 48 euros per megawatt hour, driven by expectations of higher demand as colder temperatures approach in December. Gas storage in Europe is currently 86.7% full, over 10 percentage points lower than this time last year, raising supply concerns. Weather forecasts point to milder conditions next week, but predict cooler weather the following week, adding to the anticipated demand surge. Additional risks include strong Asian demand for LNG emerging during past week. According to the excellent analysis of CRU, at this gas price level, current European producers' profitability for ammonia and urea dropped to negative in November, but still keeps positive for urea. As per analysts' valuation, we will see fertilizers production stoppages as soon as nitrates profitability will reach zero. At the highest risk, first of all, will be producers from Romania and Central Europe. Depending on the gas and imported ammonia price surge, Polish producers might also enter the high-risk zone. US natural gas futures dropped from the higher level achieved at the beginning of the week to $3.3 per MMBTU on Friday, as markets assessed the outlook of gas supply in the US. The latest report from the Energy Information Administration indicated that utilities pulled 3 billion cubic feet from storage, loosely in line with market expectations. While the result consolidated the view that the withdrawing season is underway, it was well below the 5-year average of a 30 billion cubic foot drop for the week. In turn, prices were also pressured by the view that upcoming colder front in the US may turn mild later in December. Still, export demand has remained strong in November, driven by Europe and Asia preparing for winter heating. To meet this demand, US production has increased, up by 1.5 billion cubic feet per day. Agricultural commodities future prices showed different dynamics for different crops during last week. Wheat futures fell below $5.3 per bushel, marking a 3-month low, as ample Russian exports and improved US crop conditions pressured prices. Heavy rains in the US plains boosted winter wheat conditions, with 49% of the crop rated good or excellent, up from 44% the previous week. Meanwhile, French farmers accelerated planting, with 90% of the crop sown by mid-November, exceeding the 5-year average. At the same time, risk of escalation in the war Russia against Ukraine decreased, thus concerns about Black Sea supply as well. Corn futures dipped towards $4.2 per bushel amid ample supplies and demand concerns. Production and ending stocks remain historically large, despite downward revisions in the latest USDA November report. Additionally, large carryover stocks continue to suppress prices and contribute to an ongoing inventory buildup. In turn, trade uncertainties, particularly around US export policies under the new administration, and speculation over potential tariffs on agricultural products have dampened the outlook on trade demand. Soybean futures rose to $9.9 per bushel, driven by robust Chinese demand mostly. Chinese buyers are ramping up purchases of Brazilian soybeans from the upcoming harvest, benefiting from attractive prices and abundant supply, as Brazil prepares for a record-breaking crop. This move also helps mitigate risks from rising trade tensions with the US, though American soybeans remain in play, with 4 million tons of outstanding sales to China for the 24-25 season, according to USDA. Meanwhile, Argentina's soybean planting advanced significantly, reaching almost 36% of the projected 18.6 million hectares for the 24-25 season. Moving to the shipping industry. Containerized freight index increased by almost 8%. Spot rates ex-China mostly dropped to key European and US destinations, while rates for Europe to the US and China remain stable. Index increase is driven by short-term supply disruptions at certain routes. Another factor is President Trump's announcement regarding tariffs for trade with China, Mexico and Canada to be implemented as of day one of his presidency. Despite many market analysts doubt it will happen so quickly, the direction of regulation during his presidency is clear. So, some importers are likely going to advance the imports of goods prior to inauguration date, especially for goods which are less time-sensitive and where the importer have excess warehousing space. This would further fuel the peak period ahead of Chinese New Year and the trade between China and the US. The Baltic Exchange Rate Index lost another 213 points, or 14%, and has almost achieved the lowest level this year that was registered mid-January. This was driven by an unsuccessful week across all segments, also due to festive week in the US. In Capesize segment, loss in the Pacific was connected to the persistent weather disruptions, while in the Atlantic, the activity was subdued. Panamax, Ultra-Supermax, and especially Handysize segments all suffered from low amount of fixtures in both basins. Hopefully the activity will pick up next week after the holidays in the US. To sum up, fertilizers market is entering quite a couple of weeks when activity is largely subdued and prices soften. Indeed, urea price decreased more across all benchmarks amid low demand. However, speculations about a new Indian tender to emerge before the end of the year might spark the momentum unexpectedly soon. Nitrates demand continues to be low, but increasing gas price pushes European price indications higher, thus stimulating buyers to enter the market sooner rather than later. Phosphate prices continue to be elevated and don't show the signs of decline yet. Also due to increasing raw materials cost, especially sulfuric acid, but also ammonia. New December contract price for ammonia increased by $10 in Tampa, while European CFR price also climbs. Natural gas futures for Europe continue growing amid geopolitical tensions and seasonal demand increase. US gas futures also increase, mostly due to higher demand for LNG exports also to Europe. Agricultural commodities future prices were mostly in red amid good weather conditions in key planting regions that help the crop's growth pace. Cost of container shipment is expected to increase on background of new trade tariffs expectations from new US administration. Dry bulk shipments struggled last week due to slow activity across segments and basins, with US holiday week negatively affecting market activity. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.